Alright, so we are going to start with revenue first, then profits, then margins and cash flow. Don't worry if some of these terms feels unfamiliar, we'll discuss about those later. So, first is revenue growth, which is top line. For FY 2025, the revenue was 10.7 lakh crores. That's roughly around 125 billion US dollars. Just to put that in perspective, that's larger than GDP of 150 countries. But one single year number doesn't tell us that much. What matters is the trend. So if we zoom out and let's look at the trend, so we'll find that Reliance has consistently grown in terms of revenue. Though the pace has moderated recently, which was in 25 was somewhere around 7%, and for the company of this size, it's decent. Now, here's what's important. Not all the revenue is equal. The bulk of Reliance revenue is still come from O2C, and then the business segment has contributed around 6.2 lakh crores. But the O2C is a commodity linked business. When global fuel prices move, margins move along with them. So the revenue number can look large, but the quality of revenue matters a lot. Geo and retail, on the other hand, contribute lower in terms of absolute revenue, but growing faster and with better profit margins. The mix shift from commodity revenue to consumer and digital revenue is most important thing in the Reliance long term story, and we'll keep that in mind so as we go deeper. Let's look at the profit. Net profit for FY 2025 was 81,000 crores. That's 2.9% growth year on year. Revenue grew by 7%, but the profit grew only by 3%. So, which is slower than the revenue, and that's the first flag we need to understand. The reason is simple: OTC margins squeezed, global fuel cracks spreads weakened, petrochemical deltas were under pressure. So, even though Reliance was selling more, it was making less per unit in its largest business, and that's margin compression is not unique to Reliance, but it's a global trend in the refining and chemical space right now. But here, on the other side of the story, Geo's profit grew by 22% to 26,000 crores. Retail profit grew by 11.6% to 12,392 crores. So consumer space businesses are performing well, and it's the legacy business that's pulling overall numbers slightly down. And this is actually really useful insight for valuing the company, because if and when O2C margins recover, the overall profit number could jump significantly without any operational change, and that's called operating leverage. We'll factor that into our valuation in the later part. Let's look at margins. EBITDA for FY 2025 was 1,83,000 crores. That gives us an EBITDA margin of 17%. Net margin was around 7.5%. For context, these numbers aren't particularly high margins, but here's what you need to understand about Reliance specifically. Reliance operate across different segments with various different margins. O2C typically operates around 8 to 9% EBITDA. It's a high volume and a low margin business. Geo runs at a significantly higher margins. As telecom once built out, it's a very profitable business, and retail is still in heavy investment mode. So the margins are deliberately kept thin as they expand. So when you look at a blended margin number for Reliance, it doesn't tell us the full story. What you really need to track is whether the high margin businesses are becoming a larger share of the total pie. And the answer right now is yes, slowly but clearly. Now let's look at one of the most important factor of fundamental analysis, which is cash flow, which is, I would say, which is even more important than profit, because profits can be managed but through accounting and everything, but cash flow is much harder to fake. Operating cash flow for Reliance is strong. The business generates real cash. And here's the context for you. Reliance spent 1,31,000 crores in capex in a single FY 2025 year. And that's $15.3 billion being reinvested back into the business in a single year. But now, capex at this level means free cash flow, that's operating cash flow minus capex, is under pressure, and the company is essentially reinvesting almost everything it generates into the same, and then some into building like future businesses like Geo's 5G rollout, retail expansion, and now the new energy manufacturing. So if you ask me, is it good or bad? I would say neither on its own. it depends entirely on the quality of those investments it has made. So a company that spends heavily in high return projects, it's creating future value, and that's exactly what we have to judge here. And we will do that when we get to the management section. uh, what I will say here right now is the capex cycle for Reliance is expected to start moderating. The 5G rollout is already done, and the new energy assets are nearly commissioning. So, as the capex comes down, the free cash flow should improve meaningfully, and over the next 2 to 3 years, that would be happening. So, this is the key assumption that we need to keep in mind when we go to the DCF valuation. All right, so the revenue and profits are done now. Let's look at the balance sheet because a company can still be profitable but still be in trouble if the balance sheet is weak. A company may sustain losses, but the debt can kill business. Debt analysis. Reliance debt to equity ratio currently sits at 0.43, and that's not alarming. In fact, for a company of this scale running massive infrastructure capex, it's quite manageable. But here's the nuance that you need to understand. Gross debt is elevated because of all the capex we just discussed. However, Reliance holds significant cash and liquid investments, and once you net off that with the and you calculate the net debt, which is considerably lower than the gross debt. And this is an important distinction. Always look at the net debt and not just the gross debt. Debt is not that bad. The real question is whether the company can comfortably service that debt. That's why always check interest coverage ratio to understand how the company can comfortably pay its interest from the operating profits, and that the company is itself not struggling. Now let's talk about return ratios, and this is where I want to be completely honest with you because this is one of the most uncomfortable part of Reliance story. Return on equity. ROE measures how much profit the company generates for every single rupee of shareholders equity. Reliance 3-year average ROE is approximately around 8.5. That is not a high number, but for context, a well run business should ideally deliver 15% or higher. Next is ROC, which is return on capital employed, is around 9.5%. It measures returns on total capital, including the debt. Given the massive capex cycle and the fact that new energy assets are not yet generating revenue, the capital efficiency metrics are naturally depressed right now. Now, is this a problem? Here's what I'd frame it. Okay, Reliance is in the middle of one of the largest complex investment cycles in Indian history. When you're deploying 1.3 lakh crores in a single year into business that haven't even started yet, even so, your ROE will look bad. That's just math. The real question investors should ask is, will these return ratios improve as the capex cycle ends and the new businesses start contributing? If yes, the current ROE is temporary and could be a buying opportunity. If no, it's a structural problem. And we'll build that assumption into our valuation framework later. Now, let's move on to the management and competitive positioning because the numbers only tell us the half story.